Welcome to the deep dive, everyone. Today we're going to be kind of stepping into the world of private equity.
Okay.
And I know it's a term that gets thrown around a lot, but we're going to be going beyond the buzzwords here.
Right.
And I think of this as almost like your crash course, right?
Yeah.
So we're going to be using excerpts from Nomura's Introduction to Private Equity Funds,
Yep.
as well as excerpts from Morgan Stanley's Private Equity Primer.
Okay.
And we're going to be looking at, what private equity really is, the
Okay.
strategies involved, and what it could mean for you as an investor.
Yeah, I think what's really fascinating about private equity is that it's often perceived as this exclusive playground for the ultra-wealthy.
Right.
But once you understand the basics, it becomes clear how anyone can use this knowledge to make smarter investment decisions.
Okay, so let's break down, that first misconception,
Right.
right? What exactly is private equity?
Yeah.
Is it as simple as investing in companies that aren't on the stock market?
That's a great starting point.
Okay.
It is about investing in companies or assets, not publicly traded. So you're on the right track there.
Okay.
But it's much more than just, pre-IPO investing.
Gotcha.
Nomura really emphasizes the concept of private ownership,
Okay.
often with active involvement in guiding the company.
So it's not just passively watching your money grow.
Right.
You might actually have a say in how the company's run.
Exactly.
That's intriguing.
Yeah.
Now, I know there are different types of private equity strategies, right?
Yeah, there's a lot of different approaches you can take.
Let's kind of unpack those.
Yeah, let's dive in.
And Nomura kind of kicks things off with venture capital, or VC.
Like VC, the classic.
Yeah.
It's all about high growth potential, right?
Okay.
Imagine being an early investor in companies like Google or Facebook back when they were just startups.
Right.
It's kind of like the essence of VC, backing those, potentially game-changing ideas.
So it's like Shark Tank, but with higher stakes and potentially longer timelines.
Yeah, I think that's a fair comparison.
I do love a good Shark Tank episode.
Yeah, they're entertaining.
But seriously, how does someone actually navigate the world of VC investing?
Right.
It seems like a whole different language.
Yeah, it definitely has its own jargon.
Yeah.
Nomura highlights the staged approach of VC funding.
Okay.
You have seed funding, then Series A, B, C, and so on.
Right.
So you can kind of think of it like checkpoints in a race.
Okay.
Each stage marks a significant milestone in a company's growth journey.
Okay. That helps kind of visualize the process.
Yeah.
But let's be real, not every startup becomes a Google, right?
Of course, yeah.
How do VC investors manage that inherent risk?
Yeah, that's the big question.
Yeah.
It's, high risk, high reward territory.
Right.
That's why diversification within a VC portfolio is key.
Okay.
Not every investment will be a home run, but those few that skyrocket can make up for the losses and then some.
Right. So you're spreading the risk across multiple startups.
Exactly.
Hoping that a few big winners will carry the portfolio.
So that's the idea.
Makes sense.
Yeah.
Now let's shift gears to leveraged buyouts, or LBOs.
Yeah.
This is where we kind of step away from the startup world and into the realm of established businesses.
Precisely.
Right. So LBOs involve acquiring a controlling stake in a mature company, often using debt financing.
Right. Using that leverage to your advantage.
Right. So imagine taking a company like Toys R Us private. But, LBOs happen across various industries.
They do. It's not limited to any one sector.
Right.
That's
Wait,
right.
Toys R Us went through an LBO.
They did, yeah.
I vaguely remember hearing about that, but I didn't realize it was a private equity play.
It was, yeah, a big one.
That's a pretty big deal.
Yeah, definitely a high-profile example.
But didn't that particular LBO end up kind of not so well?
Yeah, that's the unfortunate truth.
Right.
The Toys R Us LBO is actually a classic example of how leverage can magnify both returns and risks.
Right.
The debt burden in that case became unsustainable,
Yeah.
and the company ultimately filed for bankruptcy.
Oh, wow.
Yeah, it's a cautionary tale for sure.
Okay, so that's a cautionary tale.
Yeah, definitely.
So it seems like using debt can be a double-edged sword in the world of private equity.
It can, absolutely.
You're right. You could really hit it big or end up with a financial disaster.
That's the risk and reward dynamic.
Yeah, so how do investors make sure they're not getting into a risky situation?
Well, that's where due diligence comes in.
Okay.
Thorough due diligence is, critical in any private equity investment, especially with LBOs.
Right.
You really need to understand the company's financials,
Yeah.
its market position, the management team's capabilities before you even think about diving in.
Right. So it's not just about the kind of potential returns. It's
Right.
about carefully assessing the risks involved.
Exactly. You've got to balance those two.
Now, Nomura mentions that equity contributions in LBOs have actually been increasing recently.
Well, that's interesting.
Yeah, what's driving that trend?
I think it's probably a combination of factors.
Okay.
One, I think lenders have become more cautious after witnessing some of these high-profile LBOs stumble, right?
Right.
And then investors themselves are demanding more conservative capital structures.
Okay.
So essentially, I think everyone's kind of learned from past mistakes.
Right. It's like, okay, let's not get too crazy with the debt.
Yeah, exactly. A little more prudence.
Yeah, interesting. It
Yeah.
seems like the private equity world is always adapting and evolving.
It is. It's a very dynamic landscape.
Right.
Yeah.
Now, for a strategy that really kind of piques my curiosity, distressed debt.
Okay.
So Nomura describes it as investing in companies on the brink of bankruptcy.
Yeah, the high stakes game,
It sounds like playing with fire.
it can be. Yeah.
Why would anyone willingly go near that?
Well, it's definitely not for the faint of heart.
Right.
But for those with the expertise and the risk appetite, distressed debt can offer some incredibly lucrative opportunities.
I'm all ears.
Okay, good.
Walk me through this.
All right.
How can you actually make money from a company that's essentially failing?
Right. Well, there are a couple of main approaches.
Okay.
Nomura outlines them. One is debt to control,
Okay.
where you basically buy up a struggling company's debt with the goal of taking control during restructuring.
So you're essentially betting on your ability to turn the company around.
That's the idea.
That takes some serious guts.
Right.
What's the other approach?
The other one is trading distressed debt.
Okay.
And this involves buying bonds at a deep discount
Okay.
and hoping they'll appreciate in value as the company recovers or restructures.
So it's kind of like finding like a hidden treasure that others have overlooked.
Yeah, that's a good analogy.
Okay, so distressed debt is all about spotting undervalued assets and having the expertise to kind of navigate those complex situations.
It is, yeah.
Definitely not for the, the casual investor.
Probably not, yeah.
Now, Morgan Stanley brings another strategy to the table, growth equity.
Okay, yeah.
And they kind of position it as a middle ground between buyouts and venture capital.
Right, so if we picture like the spectrum of private equity, right?
Okay.
Growth equity targets companies that are past that risky startup phase,
Gotcha.
but still have significant room to expand.
Okay.
So they have, proven business models.
Yeah.
They're looking for capital to kind of accelerate their growth.
So it's like finding that that rising star in like the culinary world, right?
Okay.
Like that restaurant that's already popular,
Right.
but poised for even greater success with the right investments.
Exactly. They just need that extra push.
Makes sense.
Yeah.
Now let's kind of move beyond the strategies and look at
Okay.
the structure of these private equity funds.
Yeah, let's get into the nuts and
So
bolts.
how are they actually set up and managed?
Right.
And Nomura introduces the roles of general partners, or GPs,
Okay.
and limited partners, or LPs.
Right. The key players.
So can you break that down?
Sure. It's like a partnership with clearly defined rules.
Okay.
The GPs are the experienced investment professionals
Okay.
who manage the fund, source deals, and make those crucial investment decisions.
So they're like the head chefs, right?
Yeah, that's a good way to put it.
Okay.
Creating the menu, leading the kitchen team.
Gotcha.
Now, the LPs are the investors who provide the capital,
Okay.
but they don't have day-to-day control over the investments.
Right.
Think of them as the discerning diners, right?
Okay.
Who trust the chef to create a delicious and satisfying meal.
Okay, so there's like a division of labor.
Exactly.
Right. The GPs handle the investment expertise,
Right.
and the LPs provide the funding.
That's the basic structure.
But how does that funding actually work?
Yeah, that's a good question.
Nomura mentions these capital calls,
Right.
which sound a bit like like an on-demand payment system?
It's kind of like that.
Okay.
Yeah.
So, unlike traditional investments where you put in all your money up front,
Right.
private equity funds call capital from their LPs as needed for specific investments.
Exactly. So it's not all at once. It's
Right.
spread out over time.
So imagine you commit like $1 million to a fund.
Okay.
The GP might initially call for like 200,000 and then another 300,000 later when they find a promising investment.
That's how it often works.
So it's like paying your bill in installments as you order more dishes.
Yeah, I like that analogy.
Dude, that makes sense.
Yeah.
It allows the fund to be more nimble, deploying capital kind of efficiently. But it also means investors need to be prepared to provide additional funds when those calls come in, right?
That's right. You need to have that liquidity available.
So you can't just like put in your money and forget about it.
You need to be ready to act.
You need to be actively engaged and prepared to act when those calls come in.
That's a key consideration.
Now let's talk about the elephant in the room,
Okay.
right? The fees.
Yeah, everyone wants to know about the fees.
Nomura outlines like management fees, performance fees, and other expenses.
Right.
These funds don't come cheap, do they?
They don't.
Right.
They certainly don't, no.
Okay, so like management fees are typically a percentage of the committed capital, right?
Right. That covers the GP's operational costs.
Okay.
Keeping the lights on, so to speak.
Gotcha. And then there are performance fees, often called carried interest,
Right.
which reward the GP for generating, strong returns.
Exactly. It's their incentive to perform well.
Okay, so management fees are for running the fund. And carried interest is like a bonus for good performance.
Yeah, that's a simple way to think about it.
But honestly, that carried interest can be a big chunk of the profits.
It can be. Yeah.
Is it always justified? Or are there times when it kind of eats into investors' returns too much?
Yeah, that's a valid question.
Yeah.
While those performance fees can be substantial,
Mm-hmm.
Morgan Stanley emphasizes that they create what's called an alignment of interest.
Okay.
So the GPs are motivated to deliver strong returns.
Right.
Because their own compensation is directly tied to the fund's success.
Okay, so there's an incentive for the GPs to, perform well.
Exactly. They're not just managing other people's money.
They have skin in the game.
They have skin in the game. Exactly.
But I'm still curious about those high fees.
Right.
Are there any strategies or like fund structures that might offer lower fees for investors?
That's a great question. And it kind of leads us perfectly into the next part of our deep dive.
Okay, great.
Where we can explore the potential benefits of private equity investing and see if those potential rewards, outweigh the costs.
Perfect. All right, let's take a quick break and we'll be back to delve into those benefits right after this.
Sounds good. So, we've explored all those different flavors of private equity.
Right.
From venture capital's, high growth potential to the kind of intricacies of distressed debt.
Yeah, it's been quite a journey.
It has.
But now let's get down to like brass tacks.
Yeah. Okay.
Like, why should you as an investor care about private equity?
Yeah.
Is it just about chasing those, potentially higher returns?
Well, it's definitely more nuanced than that.
Okay.
Morgan Stanley highlights several factors that kind of set private equity apart from traditional investments.
Okay.
And one of the most significant is illiquidity.
Okay.
Now, I know we've touched on this before.
Right.
But it's worth emphasizing because it really shapes the private equity landscape.
Right. We've talked about those like long lockup periods.
Right.
But I'm curious, like, how does illiquidity actually play out in the real world?
Yeah, good question.
Like, could you give me a concrete example of how it might impact an investor?
Sure. Imagine you're an investor who needs to access a large sum of money unexpectedly.
Okay.
Perhaps for, a medical emergency or a sudden business opportunity.
Right.
If a significant portion of your portfolio is tied up in private equity, you won't be able to quickly liquidate those assets
Right.
to, meet that immediate need.
Okay, so that's a real world scenario
Well-
where illiquidity could actually pose a challenge,
Exactly.
right? It's not just a theoretical concept.
Right.
It's something that could actually impact, your financial
Yeah,
flexibility.
your access to cash when you need it.
Exactly.
Yeah.
And this illiquidity is why, this is why private equity is generally considered a long-term investment strategy.
Exactly. It's not a quick flip. You got to be in it for the long haul.
Suitable for those with a time horizon that extends beyond like a few years.
Yeah. You need patience.
Right.
and a long-term perspective.
Okay, so it's not for everyone.
Right.
Right. You need to be comfortable having a portion of your capital committed for the long haul.
Exactly.
But for those who are, I mean, Morgan Stanley points out that this illiquidity can actually be an advantage.
It can. It's counterintuitive, but it's true.
In what way?
Well, think about it. Your investments are shielded from the short-term volatility
Okay.
and kind of the emotional swings of the public markets.
Right.
So it's like having a secure vault
Oh, okay.
where your money can grow steadily, undisturbed by the daily noise of the stock ticker.
That's an interesting perspective.
Yeah.
It's like the slow cooking method
Okay.
in like the culinary world.
It's like
They're not like rushing the process.
Right.
You're letting those flavors develop slowly over time.
Exactly. Patience is key.
Now, Morgan Stanley also highlights the lower correlation of private equity to public markets. This is all about diversification, right?
It is. It's about not putting all your eggs in one basket.
Right.
Adding private equity to a traditional portfolio of stocks and bonds can really help reduce overall portfolio risk.
Okay.
It's like having a well-balanced meal, right?
Okay.
With a variety of ingredients that complement each other.
Yeah.
One ingredient might be a bit spicy, another might be sweet, but together they create a harmonious flavor profile.
So private equity is that unique ingredient that adds a different dimension to your portfolio.
Exactly.
Right. Potentially smoothing out those bumps in the road.
Right. And potentially enhancing long-term returns as well.
And enhancing long-term returns. Okay.
Yeah.
And of course, we can't overlook the potential for like higher returns.
Of course, that's often the main attraction.
Which is often cited as like a major draw for private equity investors.
It's hard to ignore.
Right. Morgan Stanley cites data showing that private equity has consistently outperformed public equity over long periods,
Right.
often by a significant margin.
The numbers speak for themselves.
But we both know past performance is never a guarantee of future success.
Of course not. No investment is risk-free.
Right. So how do we reconcile those historical returns with the inherent risks of private equity?
Yeah, that's the key question.
Yeah.
I think it's all about understanding the drivers of those returns.
Okay.
So one factor is what's called the illiquidity premium.
Okay.
Investors are essentially compensated for tying up their capital for longer periods.
So it's like getting paid extra for your patience.
Exactly, for your willingness to ride out those market fluctuations.
Yeah, commitment to the long game.
Exactly.
Oh.
Another factor is the active management approach.
Okay.
So private equity GPs, they're not just passive investors.
Right.
They're actively involved in, shaping the strategy and operations of their portfolio companies.
Right.
They're, driving growth, unlocking value.
So it's more like being like a hands-on chef, right?
Exactly.
Carefully crafting each dish to perfection.
That's a great analogy.
Okay, so it's not just about picking the right companies. It's
Right.
about having the expertise to make them even better.
Exactly. It's about adding value.
Yeah. Okay. Now on the topic of kind of opportunity, Morgan Stanley emphasizes the deep and diverse opportunity set
Yes.
that's available in private equity.
The opportunity set is vast.
So this is about going beyond the limitations of the public markets. Right?
Precisely. You're not limited to those publicly traded companies.
Right.
Think about it. The vast majority of companies worldwide are privately held.
Right.
So this represents a vast universe of potential investments
Wow.
that public market investors simply can't access.
It's like having access to a secret garden, right?
I like that analogy.
Filled with like exotic fruits and vegetables
Yeah.
that most people never even get to taste.
That's a great way to put it.
So private equity is like having a key to that secret garden,
Exactly.
unlocking those like hidden gems with the potential for growth and innovation.
That's it.
Okay, but all this potential comes at a price, right?
Right. There's no free lunch.
We can't ignore those like notoriously high private equity fees.
The fees are definitely a consideration.
Yeah, it's a trade-off that investors need to kind of carefully consider.
Absolutely. You've got to weigh the potential rewards against the costs.
So the question is, are those potential returns substantial enough
Right.
to justify those premium prices?
That's the million-dollar question.
It's a judgment call that each investor needs to make based on, their own risk tolerance
Their individual circumstance.
and their financial goals.
Exactly. There's no one-size-fits-all answer.
Cool.
Now, let's delve into another key aspect that often distinguishes private equity from traditional investments.
Okay.
And that's the control and influence that investors can exert.
Okay.
So remember, with publicly traded stocks, you're a minority owner
Right.
with limited say in the company's direction.
You're essentially along for the ride.
Exactly. You're hoping the management team makes wise decisions.
Right.
But with private equity, um, investors often have a seat at the table, a voice in shaping the strategy.
So it's more like being a partner in the business, right?
It is. You're more actively involved.
Working alongside the management team
Collaborating, yeah.
to drive growth and create value.
You're not just a passive shareholder.
That level of involvement is pretty compelling, especially for investors who, want to be more than just passive shareholders.
It can be very appealing.
Yeah.
For those who want to have a real impact.
But with that control comes responsibility.
Right. Absolutely. You're taking on a greater level of responsibility.
Private equity investors need to have, the expertise, the resources, and the commitment.
The time commitment, yeah.
To actively engage with their portfolio companies.
It's not a passive investment.
Right, guiding them towards success.
You've got to be involved.
Okay, so it's not just about writing a check.
It's about rolling up your sleeves.
It's about rolling up your sleeves.
And getting your hands dirty.
Getting involved in the operations and making those, tough decisions.
Exactly. Better the team.
Okay, now another aspect that kind of sets private equity apart is the nature of the investments themselves.
Okay.
Right. So traditional investments are typically focused on publicly traded companies.
Right, the ones everyone knows.
With, established track records.
Yeah, lots of data available.
And readily available financial information.
Easy to analyze.
But private equity, it kind of ventures into, uncharted territory.
It does. It's more adventurous.
Often backing companies that are still in, their early stages of development.
Right, or operating in niche markets,
Yeah.
the ones that are under the radar.
Yeah, we've talked about venture capital's, focus on startups.
Right.
But even within buyouts and growth equity,
Yeah.
you're often dealing with companies that aren't, household names.
Exactly, the hidden gems.
Right.
The ones with potential.
And this focus on less established or less transparent companies
Right.
introduces an element of uncertainty
There's definitely more uncertainty.
and complexity.
It's not as straightforward.
Right. That requires specialized expertise to navigate.
You need experience and knowledge.
Right. So it's not just about understanding financial statements.
Much more than that.
That's about assessing the potential of a new technology.
Right, or evaluating the strength of a management team.
Right.
Or gauging the viability of a business model that's still evolving.
It's a different kind of investment analysis.
That's a different ballgame.
That requires a different set of skills.
I need a different toolkit.
Now, let's shift our focus to a topic that's often overlooked,
Okay.
but can be crucial to the success of a private equity investment, the exit strategy.
Yes, the exit.
Right. So remember, private equity funds have a limited lifespan,
They do. They're not forever.
typically around 10 years.
That's the typical time frame.
So the GP needs to have a plan for how they'll eventually sell those portfolio companies
Right, you got to have an exit plan.
and return capital to their investors.
That's the goal.
Right. So it's not just about buying low and hoping the value goes up.
It's about realizing those gains.
There needs to be a clear path to kind of cashing out those investments and realizing those gains.
Exactly. You got to turn that paper profit into actual cash.
And Morgan Stanley outlines several common exit strategies.
Right.
Right. Including selling the company to another strategic buyer,
That's a common one.
taking the company public through an IPO,
The IPO route.
or even recapitalizing the company with additional debt
Right. Leveraging up again.
and distributing those proceeds to investors.
Another way to return capital.
So it's like a chef carefully planning the final presentation of a dish.
Okay. Yeah.
Right. Ensuring that each element complements the others.
It's all about the presentation.
Yeah. And creates a satisfying experience.
Like a culinary masterpiece.
And the choice of exit strategy will depend on a variety of factors, right?
It does. It's not a one-size-fits-all.
Including the company's performance,
Right. How well they've done.
market conditions,
Some of the markets,
investor appetite,
how eager buyers are.
and the GP's overall investment thesis.
Their original plan.
Right. So the exit strategy is an integral part of the private equity game plan.
It's not an afterthought.
It's not an afterthought. It's something that's carefully considered from the outset.
It's part of the strategy from day one.
Now, speaking of game plans, let's delve into the life cycle of a typical private equity fund.
Okay, yeah.
Morgan Stanley breaks it down into like 3 key phases: portfolio construction,
Okay.
value creation, and harvest.
Right, the 3 acts of the private equity play.
It's like a 3-act play, right?
Exactly.
With each act building on the previous one.
Leading to the grand finale.
And leading to the grand finale.
Yeah.
So, Act 1, portfolio construction, this is all about kind of setting the stage.
Right, laying the foundation.
The GP, armed with, their investment strategy,
Their vision.
and the capital committed by the LPs, starts like scouting for those promising companies
Yeah, they're on the high.
that align with their investment thesis.
Looking for the right fit.
So it's like a casting call for like the private equity world.
I like that.
Right. The GP is looking for those stars with the potential to shine on the big stage.
Exactly. They're looking for the next big thing.
And this phase can take several years, right?
It can, yeah.
As the GP carefully builds a diversified portfolio of companies that meet their specific criteria.
They're being selective.
Right. And as those investments are made, the GP will start calling capital from the LPs to fund those acquisitions, right?
Exactly. That's when those capital calls come in.
This is where those capital calls we discussed earlier come into play.
It's all connected.
LPs need to be prepared to provide those funds
You got to have the cash ready.
as those promising opportunities arise.
It's like paying for your tickets as you select your seats for the show.
Okay, so Act 1 concludes with a carefully selected cast of companies.
Right.
Each with the potential to deliver a stellar performance.
A star-studded lineup.
What happens in Act 2, the value creation phase?
This is where the real work begins.
Okay.
The GP shifts from being, a deal maker to an active owner.
Okay.
They're working closely with the management teams of their portfolio companies to enhance their value and accelerate their growth.
So it's like the director working with the actors.
Exactly.
To refine their performances.
To bring the story to life.
And bring the story to life.
Yeah.
Okay, so it's about rolling up their sleeves,
Getting hands-on.
getting involved in the day-to-day operations, and guiding those companies towards success.
That's all about execution.
And the specific strategies employed will vary depending on the company and the industry, right?
Of course, each situation is unique.
Right. It might involve expanding into new markets, developing new products or services.
Right, or improving operational efficiency.
Streamlining the supply chain.
Even making strategic acquisitions.
So the GP is like a conductor, right?
Okay.
Orchestrating a symphony of improvements.
I would like the analogy.
And innovations designed to enhance the value of the entire portfolio.
It's all about creating a harmonious whole.
And during this phase, LPs might start seeing some early distributions.
Right, they start seeing some returns.
As the GP begins to exit some of the earlier investments
Early win.
that have kind of matured and achieved their growth targets.
Exactly, those that are ready to harvest.
So it's like getting a sneak peek of the show's highlights
Okay.
before the grand finale.
A little taste of what's to come.
Right. These early distributions provide LPs with a taste of the potential return
This is a sign of progress.
and validate the GP's kind of investment strategy.
It shows they're on the right track.
Okay, so Act 2 is a period of intense activity
Well, that's where the magic happens.
focused on transforming those promising companies into high-performing assets.
Exactly, turning potential into reality.
Now let's move on to Act 3, the grand finale, right?
Aye.
The harvest phase.
The culmination of all the hard work.
This is where the curtain comes down on the fund's life cycle.
It's the final act.
The GP's focus shifts from, value creation to maximizing returns.
It's all about the exit.
By strategically exiting the remaining portfolio companies.
Cashing in on those gains.
So it's like the closing act of a play,
Okay.
right, where all the storylines converge.
It all comes together.
And the audience is left with a lasting impression.
The satisfying conclusion.
So it's about finding the right buyers.
Yeah. Finding the right match.
Negotiating the best prices.
Getting the best.
And ultimately returning capital to the LPs.
That's the goal.
Right. And the timing of these exits is crucial, right?
It is. Timing is everything.
The GP needs to carefully assess, market conditions,
What the market will bear.
the company's performance,
How well they're doing.
and investor appetite
How eager buyers are.
to determine kind of that optimal moment to sell.
It's a delicate balance.
Right. And ideally, by the end of Act 3,
Right.
the LPs are celebrating, right?
Hopefully, yes.
A successful run with with solid returns on their investments.
That's the happy ending.
It's like a standing ovation.
A round of applause.
For the entire cast and crew.
For job well done.
Of course, not all, private equity investments end in triumphant success.
Of course not. There are always risks.
Some companies might underperform.
Some investments will inevitably disappoint.
Requiring write-downs or even write-offs.
That's the nature of investing.
But a skilled GP aims to create a portfolio with enough winners.
Right. You got to have more winners than losers.
To offset those inevitable setbacks.
To come out ahead in the end.
And deliver kind of attractive overall returns for their investors.
That's the ultimate goal.
Okay. So the life cycle of a private equity fund is a journey with its own unique phases.
It's a process.
Right. Each with its own challenges and opportunities.
Ups and downs along the way.
But ultimately, it's all about generating those long-term returns for the investors.
Exactly.
Who entrusted their capital to the GP's expertise.
All about trust and performance.
Now let's shift our focus to a topic that's often debated in the private equity world.
Yeah.
The structure of these funds
Okay.
and the different types of investors who participate.
Right. The players in the game.
All right, so let's kind of explore the players on the private equity stage.
Okay.
Right. We've already met the GPs and the LPs.
The main characters.
But I'm curious about the different flavors of LPs.
Right. There's a variety.
Are they all institutional investors with deep pockets?
Historically, yes. Private equity has been dominated by institutional investors.
Okay.
Pension funds, endowments, sovereign wealth funds.
Right.
These large institutions often allocate a portion of their portfolio to private equity.
Okay.
Seeking those potential long-term returns.
Right.
And diversification benefits that we've discussed.
So it's like having a VIP section
Okay.
at the private equity show, right?
Yeah, the exclusive club.
Reserved for those with, the resources and expertise to navigate this complex world.
Exactly, the sophisticated investors.
But you're hinting that the audience is becoming more diverse.
It is. It's opening up.
Who else is joining the private equity party?
Well, the landscape is shifting as private equity becomes more accessible to a wider range of investors.
Okay.
So high net worth individuals, family offices,
Okay.
and even some sophisticated retail investors are now finding ways to participate in these funds.
Wow.
Seeking those same potential benefits of diversification and higher returns.
Mm-hmm. So it's like the private equity show is opening up to a broader audience.
It is. The doors are widening.
Right, making those exclusive seats available to those who previously might not have had access.
Exactly. More people are getting a chance to participate.
That's an interesting trend.
It's a democratization of private equity.
And this growing demand from individual investors is driving innovation in the industry.
It is. It's forcing the industry to adapt.
Right. With new fund structures and investment vehicles emerging to cater to this growing appetite for private equity exposure.
Exactly. They're creating new ways to access private equity.
Okay, so the private equity world is becoming more inclusive.
It is. It's becoming more accessible.
Right, with more options for investors of all types to participate.
There's something for everyone.
But with this growing popularity comes a need for greater transparency.
Absolutely.
And education.
Investors need to be informed.
Right. Investors need to understand the risks, the fees, and the complexities of private equity before they dive in.
It's not something to jump into blindly.
Right. And that's why, conversations like this are so important.
Absolutely. We need to demystify private equity.
We need to demystify private equity, make it more accessible.
Break down those barriers.
And empower investors with the knowledge they need to make informed decisions.
Yeah, exactly. Knowledge is power.
Now, speaking of informed decisions, let's talk about the process of selecting a private equity fund.
Right. Yeah, the selection process.
Right. It's not as simple as picking, a stock or a mutual fund.
It's more complex.
Right. There are so many different funds out there.
A vast universe of funds.
Each with its own, strategy, its own team.
Track record.
And its own track record.
Yeah.
How do you even begin to evaluate all those options?
That's a great question.
Yeah.
It's a complex process.
Mm-hmm.
It requires, careful research,
right,
thorough due diligence,
yeah,
and a clear understanding of your own investment goals and risk tolerance.
Okay.
Think of it like choosing a restaurant for a special occasion, right?
Okay.
You wouldn't just walk into the first place you see.
Right.
You'd consider the cuisine,
Yeah.
the ambiance,
The chef's reputation.
the chef's reputation, exactly.
Yeah, right.
And of course, the reviews from other diners.
So it's about doing your homework.
Gathering information.
Gathering information and making sure that the fund aligns with your own, tastes and preferences.
It's going to be a good fit.
Now let's talk about the due diligence process.
Okay.
What are some key factors investors should consider when evaluating a private equity fund?
Yeah, what are those red flags?
Yeah, what are those red flags that might signal a bad investment?
Right. Well, I think it all starts with assessing the GP
Okay.
and their team. So you want to look for a team with a proven track record,
Okay.
deep industry expertise,
Yeah.
and a strong alignment of interest with their LPs.
Okay.
So think of it like evaluating the head chef
Okay.
and their kitchen staff.
Gotcha.
You want a team with experience,
Right.
creativity,
Yeah.
and a passion for delivering exceptional results.
Okay, so it's about looking beyond the menu and
Yeah.
understanding the people behind the scenes.
The people matter.
Right.
Yeah.
What else should investors consider?
Well, the GP's investment strategy is crucial.
Okay.
You need to understand their target sectors,
Right.
their investment criteria, their approach to valuation,
Yeah.
their risk management process,
Okay.
and their exit strategies.
So it's like reading the restaurant's philosophy statement.
Yeah, their guiding principles.
Right. You want to make sure their approach aligns with your own investment beliefs.
It's got to be a philosophical match.
Okay.
Yeah.
And of course, you need to carefully review the fund's track record, right?
Of course, past performance is important.
Analyzing their historical performance.
Looking at the numbers.
Understanding the context of those returns.
A why behind the numbers.
And assessing their consistency in generating profits.
Can they deliver consistently?
It's like reading those restaurant reviews,
Okay.
right? Looking for patterns and insights that can help you make an informed decision.
Exactly. Learning from the experiences of others.
Right. So it's about going beyond the star ratings.
Right.
And understanding the nuances of those past experiences.
The details matter.
What else should investors consider when conducting due diligence on a private equity fund?
Well, you want to carefully scrutinize the fund's terms and conditions,
Okay.
including the fee structure,
Yeah.
the investment period, the lockup provisions, and the distribution waterfall.
So it's like reading the fine print on the menu, right?
Exactly.
Understanding those hidden costs and restrictions that could impact your overall dining experience.
That's all about the details.
Okay, so due diligence in private equity is a multifaceted process.
It's comprehensive.
Requiring careful research,
Analysis.
and a keen eye for detail.
You got to be thorough.
Right. It's about understanding, the GP, the team,
strategy.
the strategy, the track record,
The terms and conditions.
and the terms and conditions before committing your capital to the fund.
You got to do your homework.
And it's an ongoing process, right?
It is. It doesn't stop at the initial investment.
Even after you've invested in a fund.
Right.
It's important to stay informed.
Monitor the performance.
Monitor the fund's performance and engage with the GP to understand their investment decisions.
Right. Keep the communication open.
And their outlook for the future.
It's a partnership.
Now let's shift our attention to a topic that's often debated in the private equity world, and that is the use of leverage or debt financing in buyout transactions.
Leverage, the double-edged sword.
Okay, so we've talked about leverage in the context of LBOs,
Right.
and we've seen how it can both amplify returns
Right.
and magnify risks.
As it cuts both ways.
But I'm curious, how much leverage is too much?
That's the million-dollar question.
Is there a sweet spot where the benefits outweigh the risks?
Right.
Or is it always a gamble?
Yeah, that's a tough one.
Yeah.
There's no magic formula for determining the optimal level of leverage, unfortunately.
Right.
It depends on a multitude of factors,
Okay.
including the company's financial health, its industry, its growth prospects, the interest rate environment,
Yeah.
and frankly, the GP's risk appetite.
So it's a balancing act.
It is a delicate dance.
Right. You want enough leverage to boost returns,
Right.
but not so much that it jeopardizes the company's stability
Right.
and puts investors' capital at risk.
Exactly. You got to find that sweet spot.
And the use of leverage has like evolved over time, hasn't it?
It has, definitely.
In the past, some LBOs were like highly leveraged,
Yeah.
right? With debt to equity ratios reaching like astronomical levels.
In the wild west of leverage.
But after witnessing, some high-profile collapses,
Right. Those cautionary tales.
lenders and investors have become more cautious.
They've learned their lesson.
Right, demanding like more conservative capital structures
Less debt, more equity.
with lower levels of debt.
Exactly. A more prudent approach.
So it seems like the private equity industry has kind of learned from its mistakes
It has. Experience is a good teacher.
and adopted a more prudent approach.
More
larger.
approach.
But even with like lower debt levels,
Right.
it's still a crucial factor to consider when evaluating a buyout transaction.
It's always a fact.
Investors need to carefully assess the company's ability to service that debt,
Can they handle a payment?
especially during like economic downturns or unexpected challenges.
When things get tough?
Right. It's all about understanding the risks
Right.
and ensuring that the potential rewards justify those risks.
Weighing the pros and cons.
So leverage is a powerful tool,
It is a sharp knife.
but it needs to be wielded wisely.
Handle with care.
Right. It's not a one-size-fits-all approach.
It's tailored to each situation.
It's a carefully calculated decision
Based on analysis and judgment.
that should be tailored to the specific circumstances
Unique factors.
of each company and the prevailing market conditions.
Exactly. You got to read the market.
Now, let's delve into another aspect that's often overlooked but can be crucial to the success of a private equity investment.
Okay.
And that is the role of operational improvements in driving value creation.
Yes. Operational excellence.
Okay, so we've talked about, private equity GPs being active owners.
Right.
But what does that actually mean in practice?
It's about getting your hands dirty.
Right. How do they go beyond like financial engineering and
Yeah.
actually make those companies better?
It's about improving the fundamentals.
Okay.
Operational improvements, they involve a wide range of strategies
Okay.
designed to enhance a company's, efficiency, productivity, profitability,
Yeah.
and ultimately its value.
Okay.
So it's like, a chef fine-tuning every aspect of the kitchen,
Okay.
from sourcing the best ingredients to streamlining the cooking process to ensuring, impeccable presentation,
So it's about optimizing every aspect of the business.
leaving no stone unturned.
Right, leaving no stone unturned in the quest for excellence.
Exactly. That's a holistic approach.
And these operational improvements can like manifest in various ways, right?
They can, depending on the company and the industry.
It might involve implementing, lean manufacturing principles.
Right. To reduce waste and improve efficiency.
Upgrading technology systems.
To streamline processes and enhance data analytics.
Developing new marketing strategies.
To expand the customer base and increase sales.
So it's a holistic approach, right?
It is. It's about looking at the big picture.
Looking at the business from all angles and identifying those areas where improvements can be made.
Finding those opportunities for growth.
And this focus on operational improvements is a key differentiator for private equity.
It is. It's one of their core strengths.
Right. Traditional investors often, lack the expertise, the resources,
Or the mandate.
or the mandate to implement these kinds of changes.
They're often more hands-off.
But private equity GPs with their operational experience,
Right. They've been there, done that.
and their control over the companies they invest in,
They have the power to make changes.
can drive those transformations.
That unlock value and accelerate growth.
Right. So it's not just about buying low and selling high.
It's about adding value.
Right. It's about adding value, making those companies better,
Creating a win-win.
and creating a win-win scenario for both the investors
And the businesses they're backing.
and the businesses they're backing.
It's a partnership.
And these operational improvements often go hand in hand with financial engineering, right?
They do. They work together.
Working together to create a synergistic effect that maximizes returns.
It's a powerful combination.
It's like a chef, right?
Okay.
Combining those high quality ingredients
The best of the best.
with expert culinary techniques
The master
to
size.
create a A truly unforgettable dining
A
experience.
culinary masterpiece.
So it's about having like both the financial acumen
The brains,
and the operational expertise
the end.
to create that perfect blend of strategy and execution.
The perfect recipe for success.
Now, let's shift our focus to a topic that's often mentioned in the context of private equity. The alignment of interests between GPs and LPs.
Ah, yes. Alignment is key.
We've talked about carried interest
Right.
and how it, incentivizes GPs to deliver strong returns.
It's their motivation.
But how else is this alignment fostered?
Right. It's more than just carried interest.
And are there any potential conflicts that investors should be aware of?
Right. Because there can be conflicts.
Yeah, we've talked about the skin in the game aspect of carried interest.
Right. They have something to lose.
But I'm curious about those potential conflicts.
Right. Because they exist.
Is there ever a situation where the GP's interests might kind of diverge from those of the LPs?
There can be. And it's important for investors to be aware of those potential conflicts.
Okay.
One common concern is what's called the agency problem.
Okay.
And this refers to the potential for a GP to make decisions that benefit themselves.
Oh.
Like increasing their fees or extending the fund's lifespan,
Right.
even if those decisions aren't in the best interest of the LPs.
Okay, so there's always that possibility of like misaligned incentives.
It's a risk to be aware of.
Right. How do investors protect themselves from those potential conflicts?
Well, transparency and communication are key.
Okay.
Investors should carefully scrutinize the fund's governing documents,
Okay.
paying attention to provisions that address conflicts of interest,
Yeah.
fee structures, investment guidelines, and reporting requirements.
So it's like carefully reading the restaurant's code of conduct,
Okay.
right? Making sure their policies align with your own values and expectations.
Got to be comfortable with the rules.
Right. So it's about understanding the rules of engagement,
Exactly.
making sure those rules are fair,
Level playing field.
and ensuring that there are like mechanisms in place
Right. Checks and balances.
to address any potential disputes.
A system for resolving disagreements.
And investors should also engage in open dialogue with the GP.
Absolutely. Communication is key.
Asking tough questions.
Don't be afraid to ask.
Seeking clarification on any areas where they have concerns.
That gets those answers.
So it's about building like a relationship based on trust, transparency, and mutual respect.
A true partnership.
Well, this has been incredibly insightful.
It's been my pleasure.
Thank you so much for guiding us through this complex and often misunderstood world.
I'm glad I could shed some light on it.
It's been an enlightening journey.
It's a fascinating world.
And to our listeners, we hope you've enjoyed this deep dive into private equity.
I hope so too.
We encourage you to delve further into this fascinating world,
Keep learning.
exploring those resources we've mentioned.
There's a wealth of information out there.
And continuing your journey towards becoming a more informed and empowered investor.
That's the goal.
Until next time, happy investing.
Happy investing, everyone.